The global economy is a complex, interconnected machine, and when policies such as tariffs are introduced, they send out ripples across financial markets. Over the past few years, tariffs have played a significant role in stock market fluctuations, causing panic among investors and triggering sharp declines in stock prices. However, savvy investors understand that market downturns often present incredible buying opportunities. Let's explore how tariffs tank the stock market and why now could be the perfect time to buy stocks. Now, it's no surprise by now that we are in a trade war and there is high market uncertainty. Particularly those enacted during trade wars have introduced uncertainty in the global economy. The US China trade war, for instance, has led to increased costs for businesses reliant on international supply chains. When tariffs were imposed on Chinese imports, many US companies had to either absorb the costs or pass them down to consumers, and this uncertainty made investors nervous, leading to stock sell offs and increased market volatility. Tariffs act as a tax on imported goods, raising prices for raw materials and finished products alike. For companies in industries such as manufacturing, technology, and agriculture, this led to higher operational costs. As profit margins shrank, stock prices declined, dragging down major indices such as the Dow Jones 100 Index as well as the S&P 500. So for consumers, tariffs meant higher prices on everyday goods, which reduces disposable income and slows economic growth. This negative outlook contributed to a bearish market sentiment, scaring off both institutional as well as retail investors. The countries targeted by tariffs often retaliate with their own tariffs, leading to an escalating cycle of trade restrictions. China, the European Union, and other trade partners imposed countermeasures that hurt US exporters. Major companies reliant on global sales such as Apple and Boeing suffered as foreign markets become less accessible. Now, this uncertainty surrounding trade conflicts has caused investors to flee to safer stocks, such as gold and bonds, which further drives down market conditions. And if we take a look at the heat map, we can see that consumer defensive sector has been doing pretty well, while the technology is getting hit hard, as well as consumer cyclical and communication services. So we're actually going to talk about why now is actually a great time to buy stocks if you're able to. So while the market downturn has caused widespread losses, it also creates significant opportunities for investors, and here's why now might be the ideal time to buy stocks. Warren Buffett once said, "Be fearful when others are greedy, and be greedy when others are fearful." Right now, there is a ton of fear in the market. If we take a look at the fear and greed index, we are at extreme fear. These tariffs are no doubt going to hurt the everyday consumers, and people are overall going to have less buying power. So in my opinion, now is a great time to buy growth stocks or growth ETFs. And one of my favorites is actually the Schwab US Large Cap Growth ETF, which has a large holding of the tech sector in it. And as we can see, we're down 6% in the past 5 days, from an all-time high of $29.14 per share. If we take a look at the top holdings, we have Apple, Microsoft, Nvidia, Amazon, Meta as some of the top holdings. So it's a lot of tech companies. And what's also surprising is actually SCHD, which is known as a very defensive ETF, is down 4% from the tariff news. And it's down from its all-time high of almost $30 per share. So now is actually a good time to either buy SCHD or SCHG, as they're both heavily discounted. And remember, as the stock price decreases, this dividend yield is going to increase because you're getting cheaper shares. So for investors hesitant about volatility, dividend-paying stocks provide a safer option, and SCHD is going to be a little less volatile than something, say, SCHG, which is down almost 12% in the past month. And if we take a look at SCHG's holding, this is because many well-established companies continue to pay dividends even during market downturns, which offers a steady income stream and can help provide stability while waiting for stock prices to recover. Now, on the other hand, market corrections actually lead to future growth. Historically, stock market corrections and downturns have been followed by periods of strong growth. So investors who bought previous dips, such as the 2008 financial crisis or during COVID-19 market crash, we saw significant returns in subsequent years. The current market downturn due to tariffs could be another opportunity to invest before the next major upswing. So it really just depends on your investing style. Are you willing to take the risk for explosive growth? Or would you rather have something a little more stable, SCHD, that's providing reliable dividends and cash flow during this market downturn? Now, of course, things can change, and governments are increasingly recognizing the economic damage that is caused by these tariffs, leading to potential reductions or policy adjustments. Trade negotiations between major economies, such as the US and China, have shown signs of progress. So if the tariffs are rolled back or eased, stock prices could surge, rewarding investors who buy in now. Now, of course, if you are struggling to pay your bills and the only way to pay those bills off is to sell stocks, you are unfortunately going to have to force yourself to sell those stocks. But for people who have a little bit more flexibility with their finances, now is a great time to buy stocks. I'm personally buying up more SCHG and SCHD as they are both discounted around 4 to 5%. So while tariffs have caused significant turbulence in the stock market, downturns always present opportunities for investors willing to take a long-term perspective. Many high-quality stocks are currently trading at a discount, and trade policies are shifting. Economic measures are also in place to support market recovery. By strategically investing in undervalued stocks, particularly those with strong fundamentals and reliable dividends, investors can position themselves for future gains. Now is the time to move past fear, analyze the market rationally, and take advantage of discounted stock prices before the next economic upswing begins. Remember, the best investors don't panic during downturns. They seize the opportunity.